Okay, today we're going to be covering term life insurance based on how you'll need it for your life insurance exam. If you find this video educating, by the way, please subscribe to my channel, drop a comment letting me know what you would like to see as the next video. I'm going to be publishing a bunch of videos on things that you'll need to pass your life insurance licensing exam on the first time around. So today we're going to cover term life insurance, all right? Also, once you get your license, you can just search my name, Justin Von Eigen, and I have another YouTube channel on life insurance sales altogether. Okay, but this is just to prep you on getting through your licensing course. So, term life insurance, basics. Term life insurance is temporary protection. Okay, it provides coverage for a specific time period. So, someone can get $1 million term policy for 20 years. So, they call it a 20-year term policy. They pay a certain amount of money for 20 years. At the end of the 20 years, they may have some options, which we'll go over in a minute, but usually it's done. All right. So it's temporary protection. It provides the greatest amount of coverage for the lowest premium compared to other life insurance products. So it gives you the most bang for your buck when it comes to death benefit. Okay. It's typically used to cover things like a debt or income replacement or key person insurance. So if, for instance, like for the debt, right? Say you have a mortgage. You have a mortgage, you're not going to have a mortgage forever. So you may have a mortgage for 15 years or 30 years. So you get a term policy for that amount of time. That way, if you die, then the benefit will go to your beneficiaries to cover the house and pay off the mortgage. That way, they're not left with a bill. Or income replacement. So if there's a guy or a girl and say they make $50,000 a year and they have a young family, they just had a baby, the baby's like 1 year old, and they're like, hey, if I die, I want my $50,000 a year income to be replaced to my family, at least until my kid's in their 20s. And then they may get a 20-year $1 million term policy, right? So 50,000 times 20 is $1 million. So they may get a big policy to replace their human life value, essentially, the money that they are worth every year, essentially. So they replace that to their family. Or key person insurance, which is where a business purchases insurance on an executive to make sure that if that executive dies, then their company can have the funds to train someone, cover for any losses they may sustain in the event of that person's death, stuff like that. So term is actually, there's usually a maximum age at which it's no longer offered. So it's usually 65 or 70, I think, is like the oldest that typically companies offer term policies for. After that, it's too much of a risk for them to give that big of a death benefit away for a smaller premium. And it's pure death protection, which is pure life insurance. So there's no cash value. There's no savings element to it. Okay, people buy whole life policies a lot of times because there's a saving element, a cash value portion that accumulates cash over time. It's like kind of like a tax haven for some of your money. But so you may say, why would someone get one or the other? Well, they would get term insurance if they have to cover a debt and they want to replace income to their family if they die for an individual. And they would really get term insurance over whole life if they're like, hey, I don't need the cash accumulation as much as I need this death benefit if I die. Okay. So the insured must die during the term for the benefit to pay out, obviously. So if they have a 20-year term policy, then if they live 21 years and then die and the policy is not in force anymore, then obviously the term doesn't pay out. So they have to die within that time period. Okay, that's why they get more life insurance for their dollar, because the insurance company says, well, we're taking the risk that this person's going to die within this short time period. And if they approve approve the person for the policy, they're probably not going to die. Most term policies never pay out, 99 or something. I don't know, some crazy percent don't pay out. But hey, what it comes down to is, can your family afford for you to die? Can your beneficiaries afford for you to die? If not, then you got to get a policy like this. So the premium is always the same throughout the life of the policy, which regardless of which type of term policy it is, which we're going to go over a couple types here. So the premium is always the same, meaning the monthly payment is always the same, the annual payment. Most people pay their policies monthly. Some pay it every quarterly or semi-annually or annually, but the premium is always the same. And the premium is based on the attained age, so the age that they are when they get the policy. So if they have a 20-year term policy, right, that premium for 20 years is based on the age when they got it and their approval rating and their health at that time and all that stuff, which is in another video. It's in my underwriting video, which you'll be able to see here as well. Just click on the card. You'll see the notification if you want to learn about underwriting. Types, so there's level term policy, There's an increasing term policy and a decreasing term policy. Look, you're never going to have to worry about a increasing for this exam. They just talk about it, so I'm not even going to go into it, but there's three types: level, increasing, and decreasing. What this refers to is the death benefit, okay? Not the premium. The premium's always level. When I say level or decreasing term, it means the death benefit. I'll show you here. So level term, the most common type. Level means the death benefit is level. It doesn't change throughout the life of the policy. So it means that the insured dies in year one as opposed to the end of the term, then pays the same death benefit. The level does not have to do with the premium. Premiums are sort of averaged out, right? So it's like, okay, they're gonna pay this much at the beginning and this much at the end, and they're gonna pay the same throughout the policy. So yeah, in the beginning, the person may be overpaying for insurance, right? Because they're compensating for having to pay less later on. The premiums are averaged out over that time. Now, if a term policy expires and the insured renews it at the time, the premium is based on the attained age when it renews, right? So say this line here indicates 10 years, right? We're gonna make this a little bigger. So say this line here indicates 10 years. So let's go here 150. Okay, so say this is 10. By the way, you'll be able to get this document in the description. So look at the description. You'll find this document, a link to it. You'll be able to study it. So say this is 10 years from the age issued to the end of term. At the end of the 10 years, they can renew it if it has a renewable option. If they have the option to renew it, insurance companies usually offer that. But the premium is going to spike up. And if they're still healthy, it may make sense for them to just go through underwriting again. Essentially, the company makes it so that the person won't want to do it. That's like what the prices are. Based on. People rarely renew a term policy at the end of the 10 years. They'll most likely just get another one or convert it to a whole life policy, which we'll get into in a minute. You can actually change your term to a whole life if it has that option. Now, annually renewable term, this is the purest form of term insurance. Okay, this is just term insurance for 1 year. At the end of the year, you can renew it or not. Okay, so you don't have to prove that you're insurable at the end of the year either. So if you get approved for an annually renewable term policy, say, okay, this year it's going to be this price, the next year it's going to be this price, the next year it's going to be this price for the same death benefit. So if you look at the level term, the death benefit is level, the premium is level, okay, because it's averaged out over the time period of the term policy. Annual renewable term, we're only covering them for a year, and then they have to renew it at the end. Okay, so this, say it's 10 years, they renew at the end of 10 years. At this, they renew at the end of 1 year. The death benefit's level, but what we do is it's very cheap the first year, and then it's going to go up a little and up a little and up a little. Okay. Then there's decreasing term. So decreasing term, the premium remains the same, but the death benefit decreases over time. Remember when we say level term and decreasing term, we're talking about the death benefit, not the premium. So the premium is always the same, but the death benefit decreases over time. So this would be used to cover a debt like a mortgage, because you pay it off at like the death benefit shrinks over time. So at the end of the term, the death benefit's zero, right? Which is in a mortgage, at the end of the mortgage, the principal on the loan is zero. So you would use this to pay for something like a mortgage, because what happens is you're actually have a smaller premium, right? Because the death benefit is going to be decreasing over time, so it averages out for that premium in that term to be lower than if the death benefit was all the way up here throughout the whole time of the term. So it's usually convertible, meaning you can usually convert it to a whole life policy, but it's usually not renewable because it shrinks to zero at the end of the term. So essentially you have no insurance at the end of the term. Whereas up here, you still have insurance at the end of each one of these years, right? Or at the end of this term, you still have insurance. There's still a death benefit. This one, the death benefit goes down to zero. There's no insurance, so you usually can't renew it. Like I said, no one really ever renews a term policy unless they're using an annually renewable term. Okay. Return of premium term, there's a couple definitions for this. So they cost more money. They may give premiums back at, one version is they may give their premiums back at the end of the term if the insured outlives the policy. So there's a version of a return of premium term where if the insured pays for 20 years, at the end of the 20 years, there's a cash back option where they can get either all or a big portion of the premiums that they paid in back. Okay, they cost a lot more money. Honestly, it doesn't make sense to me for anybody to sell those, because like if say it costs almost double, for example, and you get like your money back, I mean, you've lost so much to inflation over time. If you had invested that money, the difference in something else, you'd have made a lot more, but whatever. That's just me. I'm not sold on them personally, but that is a type of term policy that's there. Some people like it, some people want them. Or the premiums are added to the death benefit, another version of a return of premium term. The premiums are added to the death benefit of the policy. So, for instance, if someone has a $100,000 term policy and after 10 years, for 20 years, after 10 years, they paid in $11,000, they die, the beneficiary will get with a $100,000 death benefit plus the $11,000 in premiums paid in. So that's another version of the return of premium term. They pay you some of the premiums paid in plus some of the death benefit. Okay. Significantly higher premiums. You can tell I've been doing a lot of recruiting. Personally, not worth it to me. So special features of term policies, you have a renewable term, which means we went over this. The policy owner can renew the insurance at the end of the term without providing evidence of insurability, so they don't have to go through underwriting again. The new premium is increased based on their attained age. So what this means, if you have a 10-year term policy, at the end of the 10 years, once the policy is set to expire, quote unquote, or terminate, right? Term terminates, they have the option to renew it, to start a term, to keep it going. What happens is their premium is going to spike up, but they do have that option to keep it there. So they can do that. The most popular form of someone renewing a term is when they have an annually renewable term or a 5-year renewable term. The 10 and 20-year renewable terms, meaning at the end of the 10-year term or 20-year term, those aren't as popular to renew because the prices spike so much. People are more likely to go through underwriting and provide another set of evidence of insurability. All that means is they go through underwriting. So the insurance company checks their health again to make sure that they're still good, and they'll issue them another policy. And the new premium is increased based on their attained age. So they do have the feature of a term policy for your licensing course, or your licensing exam, is to know that, hey, at the end of the term, a lot of time they have the option to renew the term. And then it's convertible. So that's up to a certain age too. Like after a certain age, they won't allow anyone to renew a term policy. So convertible. So this provision, it allows a policy owner to convert the policy to a permanent policy or whole life without evidence of insurability. So if they have a term policy that's convertible, they say, hey, we can convert this term to a whole life, and I don't have to show them that I'm still insurable. So they may have a 20-year term. At any time in that 20 years, unless the company specifies otherwise, the insured can convert it to a whole life. So they may say, the insurer, or the insurance company may say you have throughout the entire term to convert it. You may only have in the first 10 years to convert it, first 15 years, that's up to the insurance company. But when it has a convertibility option or convertibility privilege, conversion privilege, all the person who has the insurance has to do to exercise that option and say, hey, I would like to convert my policy to a whole life policy, and it doesn't have to be the whole amount of the term. It can be a portion of it. So they can convert, say, if they have a $100,000 term policy, they can convert 10,000 or 20,000 or 50,000, whatever it may be. The company may set certain limits on that too, but they can convert a portion of it or the whole thing to a whole life. The premium is going to increase significantly because whole life costs more money per $1,000 of actual insurance. But there's that option to do that. And a lot of people like to do that to say, hey, what's the benefit to them? I'm going to give you an applicable situation here. So that same example you used earlier, where the guy gets $1 million term policy for 20 years. Say it's coming up on the term expiring, and the guy no longer needs to leave his family $1 million, right? His sons or daughters in their 20s. Him and his wife have created a pretty nice nest egg for themselves through their careers. They don't they don't have that same financial liability, right? If he dies, it's not like his kid's going to be mooching off him for another 20 years. So what they can do is convert a portion of that to whole life. So say he's got $1 million term, right? And he says, maybe, you know what, I want $100,000 of permanent insurance to add to my legacy, maybe cover any estate costs that come up or things like that when I die. Whatever he may want it for, or to start accumulating some cash value, so they can do that, so that they can continue with the permanent insurance at that really good rate he got initially without having to go through underwriting again. And the premium at that time, although when they convert, is based on their age when converted and what that company's rates for whole life are at the time. Premiums are higher for whole life with the same death benefit because it's guaranteed to pay out at some point, right? For a term policy, the company's saying, we have a very good idea that this person's going to live for the next 10 or 20 years based on our underwriting. But a whole life, they're not going to say, we have a really good idea this person's going to live forever, right? So it's a guaranteed payout. That's typically why they may cost more. And it has a cash value portion as well. So the company is starting to return some premiums. Hey, Leah, say hi to all the students. Okay, cool. And my name's Justin Von Meyen. If you want to email me any questions, just email me jve@thejve.com. And I'd be more than happy to help you answer any questions for your licensing course. I hope this helped you. Keep in mind, take a look and subscribe to my channel. You're going to see something coming up here to subscribe to my channel, and check out any of the other videos on my channel that may help you pass your course. Thank you so much.